Most of us have probably heard that interest rates drive currencies, and that's true. The largest influence that drives the Forex is interest rate changes made by the 8 global central banks. Interest rates can be used by central banks to affect exchange rates, control inflation, or even stimulate growth. Now, like we just talked about, increasing interest rates will increase demand for a currency because it becomes attractive to foreign investors, thus increasing the exchange rate of the currency. So the interest rates are raised, money flows into that currency because it becomes a higher yielder, and that increases the currency valuation. Decreasing interest rates, on the other hand, lessens the demand because it becomes less attractive to foreign investors, curbing flows into currencies with higher rates offering a better ROR on their investments, and that's rate of return. Okay, so we're keeping it pretty basic here, but something you need to understand about interest rates and the Forex market. And when you hear everybody talking about potential rate hikes, and when you see the market react to rate hikes or rate cuts, this is why. So you need to understand why. This helps to understand the current sentiment of the market as well. Because if you hear a lot of talk, for example, like we hear right now, we hear a lot of talk about a potential June rate hike, about a potential September rate hike if it doesn't happen in June. Right now, the market is reacting to the intraday data based on that sentiment, based on trying to determine if the Fed is indeed going to raise rates in June or not. Okay, then once the market pretty much understands, the sentiment will change, because right now you're starting to see some of that. You're starting to see the market has already started to discount the idea of a June rate hike. Okay, we've had just a good flow of negative data coming out of the U.S., and I think right now the market is starting to discount the idea of a June rate hike. Okay, so that's easing that sentiment a bit right now as far as a rate hike for June. So the market's becoming a little bit less reactive to each individual release. But it's going to come back. After the June meeting, okay, we're going to see a reaction to the rate decision. Okay, when the Fed more than likely decides not to cut rates, we're still going to see a reaction to that because it's been the talk. Okay, it's been the focus of the market. Then the market's going to start to talk about September. Okay, so over those months, the Fed's probably going to come out with a statement saying that they're going to become or stay data dependent, yada, yada, yada. And the market's going to go back to being very sensitive to those individual data releases. Now, in that case, if the market's talking about a rate hike, when we get GDP numbers come out that are good, it's probably going to increase the dollar. If we see GDP numbers that come out bad, it's probably going to weaken the dollar. Okay, because the market is focused on interest rates. Okay, so this is why it's good to have a good foundational understanding of the fundamentals of sentiment and how the market reacts to these different things, the underlying things that drive the currencies and drive the day-to-day trading.